Welcome to AARO Academy, your source for expert training on advanced group reporting and financial consolidation, including specialized courses on IFRS, GRI, ESG, and more. In this video, we will address some frequently asked questions about accounting for leases under IFRS 16, with a specific focus on the right of use assets. We will address questions such as key inputs when determining ROU, determining restoration costs, how the right of use asset is subsequently measured, how an entity determines the right of use asset depreciation period, among others. Stay tuned to learn more about how IFRS 16 may impact your financial reporting. Let us start with an introduction on IFRS 16. Then we can answer some of the most frequently asked questions. IFRS 16 provides a single lessee accounting model requiring lessees to recognize a right of use asset and a lease liability on the statement of financial position for all leases unless the lessee has applied the recognition exceptions. That is, if the lease term is 12 months or less, or the underlying asset has a low value. What does a single lessee accounting model mean? A single lessee accounting model means that all leases held by lessee, either previously classified as operating or finance lease, are all accounted for using a single on-balance sheet accounting method. Implementing a single lease accounting model simplifies the process for lessees by removing the need to classify leases as operating or finance for different accounting, making financial reporting more consistent and easier to compare across companies. It also helps stakeholders analyze a company's financial standing more effectively. What are the key inputs when determining ROU at initial measurement? An entity determines the right of use asset by calculating the initial measurement of the lease liability, adding lease payments made before the commencement date, including the initial direct costs incurred by the lessee, factoring in restoration/dismantling costs, and subtracting any lease incentives received. What are restoration costs, and how does an entity determine them? Restoration costs are costs to be incurred by the lessee in dismantling and removing the underlying asset and restoring the leased asset to the condition required by the terms and conditions of the lease. The restoration cost of a right of use asset is typically estimated based on the condition of the asset at the end of the lease term and the expected costs of restoring it to its original state. This estimation may be done by the company's management or by external valuation experts. Before we move on to the next set of questions, allow me to introduce you to our IFRS 16 training. Here, we explore practical strategies for entities to accurately estimate restoration costs associated with leased assets. This concise 2-half-day course is designed for anyone involved with lease accounting. No need to be an AARO user to benefit. Whether you're a new finance professional or need a refresher, our training covers key aspects from the basics of lease definitions to the practical expedients and transition options under IFRS 16. Join us to gain from the expertise of our subject matter experts and tackle lease accounting challenges with confidence. Sign up today and enhance your ability to make informed decisions in lease accounting. Which measurement model should an entity use to subsequently measure the right of use asset? Choosing the correct measurement model under IFRS 16 is crucial for ensuring accurate depiction of ROU assets in financial statements. Entities must measure the right of use asset using a cost model, except in cases where the ROU relates to an investment property and the lessee fair values its investment property. The ROU relates to a class of PPE to which the lessee applies IAS 16's revaluation model. Again, we invite you to join our IFRS 16 training to gain valuable insights into the cost model, fair value model, and revaluation model. Under the cost model, is the depreciation period always similar to the lease term? Depreciation period refers to the amount of time over which the right of use cost is spread out. The depreciation period is not necessarily similar to the lease term. It is determined as follows. For an operating lease, the depreciation period is the shorter of the lease term or useful life. For a finance lease with purchase option, the depreciation period is the asset's useful life. how do we automate our IFRS 16 computations? Investing in a system to accurately measure the right of use, asset, and lease liability during initial and subsequent measurements is crucial. The AARO IFRS 16 Lease tool is a software solution designed to help companies comply with the IFRS 16 guidelines for lease accounting. It automates the calculation of lease liabilities, right of use asset, and other lease-related financial information, making it easier for companies to accurately report their lease obligations in their financial statements. Don't miss out on optimizing your IFRS 16 compliance. Check out our website for more information on the AARO Lease IFRS 16. As we wrap up this enlightening session, it's important to remember that becoming proficient in IFRSs like IFRS 16 is a continual process. AARO Academy encourages you to join our community for continuous learning, support, and collaboration. Benefit from the knowledge of our experts and grow with us. Together, we will navigate the changing world of financial reporting, embracing both the obstacles and possibilities it offers. For deeper insights and continued learning, AARO Academy offers a range of resources. Visit our website for expert-led webinars and interactive workshops tailored to help you navigate these changes effectively. Thank you for joining AARO Academy. We value your support and would like to invite you to subscribe to our YouTube channel for more insightful content and updates. Thank you.